Hello and welcome to this market and economic update. I'm Callie Breeze and it's my pleasure to welcome you on behalf of Thrivent and our financial advisors. It's been quite a start to the year and our investment leaders are ready to share insights on the most pressing economic and market drivers. This includes market volatility, tariffs, inflation, and more. And it's April 15th, tax day, so we have a special guest here to talk about municipal bonds. Your pre-submitted questions have helped shape our conversation today, and we'll also have a live Q&A portion during our last 15 minutes together. If you have a question, you can type it into the Q&A box at the bottom of the Zoom screen at any time. Market volatility can be especially stressful. So if you want to understand more about how to approach your personal financial strategy after our time today, your financial advisor is the best resource for you. So let's dive in. I am joined today by David Royal, Chief Financial and Investment Officer, Steve Lowe, Chief Investment Strategist, and Stephanie Weppel, a Senior Portfolio Manager covering municipal bonds for Thrivent. Thank you all for being here.
Great to be here.
Thank you. David, do you want to continue our tradition and introduce Steve and Stephanie?
I'd love to. And longtime viewers will be familiar with Steve's background, but he's kind of covered it all. He started managing equities, picking stocks, and then he was our head of fixed income for a number of years, and then now runs our mixed asset team, which oversees, among other things, our flagship asset allocation funds.
Wonderful. Thanks for being here, Steve.
And we are thrilled to welcome Stephanie here today. Stephanie, as Callie said, manages our municipal bond portfolios. And in addition to being tax day, we thought, given all the turmoils going on, it'd be just great to talk about municipal bonds, which are often viewed as a safe haven in times of economic stress.
Yeah, a lot of money running to a safe haven these days, yes. We do want to begin by acknowledging the turmoil in the economy and the markets. And that, especially when it's driven by kind of those political environments, can bring out some strong emotions. And our conversation today really isn't meant to be a judgment call on whether a policy is right or wrong, but it's instead to interpret what it could mean for the markets and the economy.
Yeah, in times of stress or turmoil, I think it's important for Thrivent to be a source of calmness and objectivity. And in times like this, we'll even be talking about areas of economic opportunity and where we think we can see good investments. We don't want to come off as insensitive, where people have the same emotions as everyone else. We just believe that by focusing on investment results, that's the best way we can serve all of you, our clients, in difficult times.
Absolutely. So with that kind of caveat up front, let's dive in. Question number one for you, David. Market volatility, it is delivering the 2025 roller coaster ride that we alluded to in November and in January. We often talk about market behavior towards the end of our time together, but we're moving it up front because we know it is top of mind for our clients. So tell us a little bit, what is behind the market volatility so far this year?
Sure. And as I mentioned in our last market and economic update, we were anticipating this volatility in part because stock market volatility was historically low in 2024, but this volatility's really been more than anyone expected. By some measures, it's as high as it was in March of 2020 during the COVID peak or during the financial crisis of 2008 or 2009. Last update, I said what I thought could drive more volatility is that there were risks to both sides of the Fed's dual mandate, which is full employment and stable prices. We'll talk more about tariffs as a source of volatility, but from a purely macroeconomic perspective, I think what's driving the amount of volatility we're seeing is that there have been signs of both stubborn inflation and also some signs of economic weakness recently. But I want to be optimistic today, Callie, especially as market sentiment is turning negative. I'm naturally a contrarian.
Yeah, you're right.
And the bullish case here is that inflation was running pretty hot in January. We'll talk more about that. But average hourly earnings in the January jobs report were 0.5%, which is quite high. And the inflation index, the consumer price index in January came in significantly higher than expected. So this slowdown in economic activity we're seeing in March and now into April could keep inflation under control and allow the Fed to cut rates several times in 2025.
Yeah, I think another key part of the volatility is just uncertainty.
Yeah.
If you look at trade policy, uncertainty is at record levels. It's also very elevated for economic policy too. And the issue is you don't know what's going to happen. Markets get volatile.
And markets do not like uncertainty. We know that.
Absolutely true. Well, before we dive into some of those factors more that you both hit on, I want to make sure we give Stephanie a chance to kind of explain what municipal bonds, or muni bonds as we call them, how they kind of work, what they look like. So Stephanie, with that little teaser, would you tell us more about muni bonds?
Yes, of course. Thank you, Callie. I'm happy to be here today. Municipal bonds are bonds that are issued specifically for public infrastructure projects, things like building roads, bridges, airports, museums, anything really deemed by the IRS to be public or essential in nature. Municipal bonds are issued by governments and government-adjacent facilities, entities like cities, counties, states, also community districts, fire districts, library districts, things like this. Municipal bonds are issued by essential service entities like water sewer plants and power plants. And they're also issued by nonprofit entities, museums, universities, healthcare institutions. All in all, it's a very diverse group of issuers. We have over 55,000 unique borrowers within the municipal market, and about 75% of the infrastructure across the United States is actually funded with municipal bonds. So what makes municipal bonds attractive to investors is that the interest or the coupon payment that you receive on this investment is tax exempt, meaning you do not pay federal taxes on that income stream. And if you happen to live in a state where the bond is issued, you may not have to pay state taxes either.
Wow.
Yeah, so muni bonds or muni bond funds are a great way to get tax advantage income in retirement. That's a frequent use for it.
And proving the point right out of the gate why we had you on tax day. So thank you for that. Okay, I'm coming to all three of you with this question. Steve, start with you. We touched on markets, but now I do want to jump back a little bit and take a high-level look at the economy. We are hearing a familiar term, one that we, put in the rearview mirror, we had hoped, recession. Would love to know from all three of you, what are you seeing so far this year?
Yeah, sure. You do hear a lot of talk about recession right now. Overall, the economy has been holding up very well. Growth was solid last quarter, but that's really in the past. And the concern is what's going to happen in the future. And now there are increasing risks to economic growth. And one part is that people just don't feel very good right now. And that's been going on for a while. And they're very concerned about the future. And in particular, confidence has fallen a lot. You see that in poor consumer confidence. You see that in poor CEO confidence. And the economic data overall is holding up pretty well. But if you look at survey data, which tends to be more questionnaires and a little bit more emotional, that's fallen a fair amount. But if you look at the actual data, what we call hard data, that's been good. The labor market, there's still jobs being created, factory orders are still good, and consumers are still spending. So overall activity has been good, but there are signs of slowing. The economic data has started to miss expectations. Overall, retailers, some big retailers that we're all familiar with, have guided down earnings. And there's a package company that's kind of a bellwether of the economy and that delivers to your house. They guided down earnings. And you can see delinquencies on credit cards have risen a bit. Auto loans, they've risen a bit. So overall, I think recession odds have definitely increased. And the longer there's uncertainty, the greater there is that we have a recession. I mean, what worries me a little bit is that economies are non-linear, meaning that weakness can spread because one area gets weak, but there's suppliers and other people dependent on that, and that weakens too. If you look at what are the odds of a recession, it's a broad survey, put about 45% odds on it, and this is a survey of economists. I think that's about right. It's less than 50-50. A recession is certainly not a foregone conclusion. I think the key to it is getting through this period of uncertainty and getting more certainty. And there's long-term positives about the economy, productivity, investment in artificial intelligence, investment in manufacturing, and so on.
Yeah. David, what would you add?
Well, as I indicated earlier, I think some slowing in the economy was probably helpful. That'll keep inflation under control. The March Consumer Price Index inflation measure came in well below expectations. So my concern now, though, that would be with the shock to the economy around tariffs, could it possibly slow too much? As Steve said, we're still not predicting recession, but the odds have probably risen. But employment is strong, but it's also nonlinear, as is the whole economy, as Steve mentioned, because inflation often doesn't doesn't rise until we're already in a recession. It's not a leading indicator, it's more of a lagging indicator. One indicator to look at is what's called the JOLT survey, the Job Openings and Labor Turnover Survey. And that ratio peaked, the number of job openings to unemployed, close to 2 coming out of COVID, when jobs were very abundant. That ratio is down to about 1 to 1. So there's about 1 job open for every unemployed person. When that ratio goes below 1, that's when you can see a spike in unemployment, because people that lose their job can't easily find, there isn't just another job waiting for them. One thing I was looking at is there was a big jump in people employed part-time for economic reasons in February. So people were working part-time who wanted to work full-time. That was in the February jobs report. And I was looking at that closely because that can precede a jump in unemployment. I was really pleased to see that trend reverse, and there was actually a negative number in the most recent jobs reports from March, which was a great jobs report kind of across the board.
Yeah, even better what the market was anticipating.
Better than expected.
Yeah. Stephanie, what would you?
Yeah, so uncertainty is certainly driving the market. That's created a lot of volatility, and municipals are certainly not immune from those interest rate fluctuations and market turmoil. Last week alone, we actually had the most volatile week on record in terms of municipal price changes. I'm of the mind that the economy is resilient and will be resilient even if we see a bit of a slowdown. Municipal bonds in particular are very resilient, and that's really by design. It's a mature asset class. It has a long-standing tested repayment systems, things like property taxes, income taxes, sales taxes, even things like vehicle registration fees that you pay. These are pledged to municipal bond repayment. These deeply ingrained repayment systems have really led to a historically low default rate across the market. And so whatever the path of the economy, and there will be price volatility, municipal bonds have been, and I fully expect will continue to be a safe haven during economic turmoil.
Well, let's talk about something that we also usually talk about later. We want to talk about early, the geopolitical environment. You've already alluded to this, Steve, but much of the recent volatility is related to the change in the new administration's posture on trade and tariffs. How are those taking shape, and how might it influence the economy and markets?
Sure, and that is the source of the uncertainty we've been talking about. I mean, markets have struggled because trade policy has been changing. There's constant news flow and it's shifting. A bit of it feels like a roller coaster, and that creates volatility. And the issue is that a high level of uncertainty can paralyze decision making, both for consumers, but more importantly for people running companies, CEOs. So I think it helps to step back and look at what the goals are of the administration. I mean, tariffs are the key tool for part of a long-term strategy to rebalance trade. In particular, we have a very large trade deficit. Key to that goal is rebuilding manufacturing. If you look at manufacturing jobs, they used to be about 40-ish% of the workforce, and now they're below 10% right now. Another goal is to kind of level the trade playing field. U.S. tariffs are generally lower than the rest of the world, and the other key issue is what are called non-trade barriers that are very significant. So these are things like regulatory issues or quality controls or quotas or guidelines over what kind of food you can have, and that can imbalance trade. So what are the impacts? The first is an increase in inflation because tariffs raise prices. It's paid by the importer. And it kind of functions as a tax on imports. And if you're an importer, you have basically 4 choices what you do. You can either pass it on to the consumer, you can absorb the increase yourself, you can press the exporter for lower prices, or you can look longer term to resource and build manufacturing here. And the reality is it's all 4 are going to happen. The other key impact of tariffs is it can slow growth because prices go up and that tends to dampen economic activity. And there's also retaliation against the United States raising tariffs there, and that can slow export activity, which is important, by making U.S. exports less competitive. So if you look at estimates, and there's a wide range of how this does, but generally somewhere around like 1.5% lower economic growth and 1.5%
in GDP?
In GDP, and 1.5% higher inflation.
Wow.
But again, there's a lot of uncertainty over that. I would expect to see negotiations and deals lower that. And if you look at past trade issues, which we had in the first administration, in around 2018-19. Once there was clarity over trade policy, markets kind of moved on. They were able to price in the risk and proceed.
Yeah, it's kind of amazing how tariffs have really taken center stage. Last week's CPI inflation came in below expectations, and any other time you would have expected that to really move markets, that treasuries would rally, but it wasn't really even a blip on the screen, and treasury rates continue to go up.
Headlines.
Didn't matter, that's backward looking.
Exactly.
Right?
Yeah, and I mentioned the strong jobs report, same thing.
Yeah.
It was barely covered in the news, it felt like.
Yeah, absolutely. Steve, I'm going to stay with you. What might the impact of those tariffs be on consumers?
We've already seen a large impact just on them coming, in that confidence has fallen. And consumers already entered this with low confidence. They're really, really worried about prices before the tariffs. And if you look at the number one issue that consumers had, it was high prices. And we've talked about that in the past. That was the number one issue they wanted addressed. And you've seen inflation expectations rise. That's what people expect in the future. And the University of Michigan does a widely followed survey, and one-year inflation shot up to about 6.7%. So to put that in perspective, that's the highest since 1981. And remember, the Fed's target is 2%, so it's a lot higher than that. And what the Fed doesn't want is for inflation expectations to become embedded, because what that does is it changes behavior. If you're a company, you raise prices proactively. If you're a consumer, you try to hoard sometimes and buy ahead.
Not toilet paper again, I
Well,
think.
yeah, that was a different issue. And workers tend to demand higher wages, and the issue with that is that can increase costs for a company and then raise prices. And another key issue is the sequencing of tariffs. Is first of all, it dampens growth and it can raise prices, but the benefits from them of reordering trade would be much longer term. It takes time to reshore production, years. I think as long as the economy holds up, and particularly the job market, the impact will be somewhat buffered. Because if consumers have jobs, they have income, and they will continue to spend. And so far, consumer spending has held up despite low confidence. The expectation is that we see weakness in the data, but not really this cliff, this sharp erosion.
David, let's talk a little bit more about the international picture.
Yep.
Steve touched on it with global trade, but what are the other themes and issues you're seeing there?
Yeah, in terms of global markets and the economy, international markets, notably Europe, rallied pretty strongly to start the year. Now, it had sort of a technical feel to it, because that rally started literally as you were flipping the calendar into 2025. And domestic large cap companies, the Magnificent Seven, were up huge in 2024, and we've probably reached peak American exceptionalism as an investment thesis, or at least folks were looking in other directions. Europe's been weaker recently. Tariffs are a significant challenge for Europe. They have a significant portion of exports in their economy. But more broadly, the industry composition in Europe is cyclical and economically sensitive. If we have a slowing global economy, and I think we likely do, then you don't want to be invested in a lot of manufacturers, energy, and financial companies, which are really what dominate European markets. One potential bright spot for Europe is German fiscal stimulus around defense and more broadly, which could help stimulate the German economy in the short term. And Germany is the growth engine of Europe. It's the largest economy in Europe. And Germany is one of the only major developed country that doesn't have a large debt to GDP ratio. So they have some room for fiscal stimulus. On China, we continue to be skeptical. Tariffs are going to be a challenge given their reliance on exports. And as I think I've mentioned before, they have a structural problem in their real estate market, which is a huge portion of their economy, and continue to have structural demographic challenges. So we're still like domestic stocks over international right now, despite that little rally at the beginning of the year.
Yeah, global trade is important for the U.S., but much less important than it is for other economies, particularly Europe and China. So it's hard to see them thriving with disruption in global trade.
David, jumping back to that consumer theme, how are consumers feeling, and how could that impact the economy?
Yeah, well, Callie, I always love to talk about the consumer. And the consumer's still spending. Retail sales have been better than expected and better than many had feared. And we've seen kind of a continued bifurcation. Higher income consumers, especially homeowners, are doing better than renters. Since 2019, since before COVID, we've seen an over $10 trillion increase in home equity as home Home prices have risen, and consumer balances on home equity lines of credit are very low. So consumers have a lot of liquidity and equity built up in their homes that they could tap if they would like to. So the consumer is generally okay. We've seen pockets of weakness, particularly in the lower income areas, and it's been tough, certainly been tough for renters. But this decline in confidence that we've seen could be self-fulfilling.
Interesting.
The consumers feel much better about their current condition than their future conditions. And they've felt this way for a while. And I have to be honest, they've largely been right. We have seen a bit of a slowdown. So maybe we shouldn't discount the wisdom of Main Street.
Absolutely.
And the consumer is absolutely critical to the U.S. economy. It accounts for about 2/3 of overall activity.
A much larger proportion than, say, in China.
Oh, much larger.
Yeah.
David, you have also mentioned inflation. I've started to see the term stagflation pop up more recently, too. How is inflation trending, and are we at risk of a stagflation environment?
Yeah, so Fed Chair Powell, who, by the way, I think is doing a good job at what has to be one of the most difficult jobs in the world, he's gotten several questions on stagflation in recent meetings, and he said something to the effect of, I don't see the stag or the flation, meaning I don't see the economic weakness or stagnation, and we certainly aren't seeing massive inflation like we did in the 1970s. At the Fed's most recent meeting, they released their Summary of Economic Projections, it's called, and it showed reduced growth expectations, but a rise in inflation expectations. So directionally, reduced growth and higher inflation is stagflationary, but we're far from the situation we saw in the 1970s. We have unemployment around 4% and inflation a bit less than 3%. As longtime viewers know, I like to look at inflation on things that are particularly visible or important to consumers. And last month's report was good overall. It was lower than prior months, but it was a bit of a mixed bag for consumers. A couple of the pain points, energy and used car prices declined, but groceries in particular remain stubbornly high.
Like those eggs.
We might as well have had gold eggs. They might have been cheaper.
Steve, coming back to you, how about the employment picture? You've touched on it a little bit, but also how are company executives feeling?
Yeah, the job market has held up well. David referenced that last job data was extremely well, beat expectations. The economy is solid, and we're still creating jobs, and that helps. And
but it certainly can be a backward-looking indicator.
Yeah, it is very much a backward-looking indication, and there's a lot of uncertainty right now. And if you're a CEO, one of the things you're going to do is you're going to slow hiring, in particular. And laying off people will come with a lag. But if you look at overall, the unemployment rate is very low. It's 4.2%. New unemployment claims are extremely low versus history. And David references that job openings have fallen. I would say they're kind of at a normalized level because they were very high during the pandemic because people left the market. So there's 2 openings for every unemployed person. Interestingly, the quit rate has ticked up. That's a sign of a strong market. In other words, you don't really quit your job unless you're confident you can find one. Hiring has been steady, showing that businesses so far have seen opportunities, and they see opportunities, they're going to hire. You know, the one concern I have is that layoff announcements have shot up, and those actually come before people are cut by several months. And it's also important to note that you haven't seen anything going on with the federal government show up in really a material way.
Fall, something like summer, early fall.
Okay.
You know, I do expect job market to weaken. As I mentioned, in particular, CEO confidence is down, and if they lose confidence, they slow hiring. Bottom line, I expect it to soften, but I don't expect this sharp deterioration. But continued uncertainty would definitely weigh on job market because people are going to pull back and wait and see how things develop.
Yeah, absolutely. So next question for both you and David. The Fed's dual mandate is full employment and stable prices, and interest rates are the tool that they use to kind of keep those in balance and strong. Is it looking like we'll have a rate cut anytime soon, and maybe even just to be provocative, any chance of a rate hike?
There's always a chance, but if inflation continues to rise, but it's not likely. I think rate cuts are much more likely. The Fed's near-term goal, I would describe as do no harm.
Yep.
Go slow and watch. The issue is that potential impact of tariffs puts the Fed in a really tough spot because it can increase inflation and slow growth. So what do you do if inflation is too high, you raise rates. What do higher rates do? They slow growth.
Yep.
And if and the reverse too, if you cut rates to help growth, that can fuel inflation. So I think the best, the way they're approaching is just see how the data plays out. If you look at their own forecasts, they're expecting about 2 quarter-point cuts. But that's a little stale. That was a few months ago. And overall, I think the theme, again, is uncertainty. If you look at the summary economic projections, they label how much uncertainty they have over their forecast, and it was really elevated. But they're still very concerned about inflation. Recent speeches have skewed toward what we would call hawkish. In other words, we have to keep inflation in check. But I think if you look at the markets, they're expecting a growth concern that overrides anything inflationary, because they expect about 4 quarter-point cuts this year. So the market is more concerned about growth than inflation at this point. Given uncertainty and these dueling forces of inflation and slowing growth, I think the Fed just holds tight, assesses it, and somewhere around mid-year they start cutting.
Yeah. David, what would you add?
I was starting to think seriously a couple months ago that the Fed's next move might actually be a hike. The market hadn't priced one in, but it was kind of starting to reflect. The probability was creeping up a little bit. And that was based on the hot wage and inflation data that we saw in January that I mentioned earlier. I agree with Steve. I don't think the Fed's going to hike in 2025. And more importantly, I don't think they want to. It would be a bit of a hit to their credibility. They've already started a cutting cycle. They don't like to reverse course if they don't have to. And I think the Fed is actually in an analogous position to many of us. They're not sure what the future holds, and that makes them more likely to either stand pat or kind of just stay on the current course for now, which would be like maybe a few rate cuts. But it's important to remember that these predictions for Fed moves and these market expectations, these are averages. And there's a lot of tail risk on either end. We could see a significant slowing in the economy that would require the Fed to cut far more times than we're expecting right now, or the opposite. We could see an uptick in inflation, whether due to tariffs or some other factors, that would actually bring a rate hike back into play. So as Steve said, I think there's a lot more uncertainty. There's a much broader spectrum of possibilities right now than there usually is.
And I think one reason they're comfortable not doing anything right now is they view their rate, which is at 4.5%, as being restrictive. In other words, it's already slowing growth, and there's no reason to raise rates right now.
That's a good point, because if we do have growth concerns, with rates where they are, they have room to cut. That wasn't the case a number of years ago.
Great. Well, all of this talk about rates sounds like they might be making a case for muni bonds. We're going to show a short video to give you all an idea of actual muni bonds at work, and then we'll come back for more discussion with Stephanie.
Municipal bonds have been around for over 100 years. They were established by the federal government in order to make investing in public infrastructure attractive to investors. Municipal bonds have a tremendous impact on the community. You can kind of see it wherever you go. When you wake up in the morning, your clean water is largely financed with municipal bonds. When you drive to work, your roads, your bridges, your tunnels are financed with municipal bonds. Other things that you'll encounter: universities, hospitals, museums, research institutions, senior living facilities, charter schools, all of these things financed with municipal bonds. Hmong College Prep Academy has been around for 20 years, and by utilizing the municipal bond market, they were able to access the public markets and do so at a much lower rate than they would have been able to in a taxable market. I think if you didn't have the municipal market, these issuers, oftentimes very small issuers, would not have the mechanisms to access public funding. A lot of the projects you see around you simply would just not be completed. Municipal bonds are sort of the epitome of investing locally. Many investors enjoy the fact that their money is being put to work solely in the United States, and that is being used for the advancement of jobs and education and infrastructure development.
All right, Stephanie, I love hearing how passionate you are about muni bonds, and it was very cool to be able to see all those places that happen because of them. Coming back kind of to the question at hand, are we in an environment where rates are making munis attractive?
Yes. Short answer, yes. Rates are very competitive versus alternatives, particularly corporates and treasuries, and in an absolute sense. In fact, investment grade muni bonds are touching the highs in yields not seen since 2011. So if you're in the camp that rates are going to stay relatively range bound or even continue to exhibit some volatility in the near term, but then eventually come down, now is a really good time to consider municipal bonds, particularly if you're looking to lock in higher yields for a longer duration or a longer time period and potentially capture that price appreciation. So to give kind of a real world example how this works, right? Currently, the investment grade index is yielding well north of 4%. I'm going to call it 4% for this example. If you are in the 22% tax bracket, you would have to buy a taxable bond at a 5.13% to get the same after-tax income as you would get with that 4% muni. If you're in the 32% tax bracket, that taxable bond rate goes up to 5.88%. And if you're in the highest tax bracket, it's actually a 6.76% taxable bond that you would have to buy, yeah.
And so if you look at taxable bonds like a corporate bond, you're not going to find a high quality bond around 7%. You'd
Right.
probably be below investment grade.
Right, exactly. So the investor gets a lot out of it, right? They get their tax exempt income, they an attractive yield, but the real benefit is actually to the borrower, right? They're accessing the market at a 4% versus a 5.5%, 6% yield. And who is the borrower? The borrower is the government, the university, the hospital, and who pays their bills? We do, right? We're the taxpayers, the ratepayers. And so without the municipal market, without that, in order for them to access, our taxes would be higher.
Yeah, it makes sense. How do you, I remember you talking about this 55,000, right? How do you hear about and evaluate these muni bond opportunities?
Yeah, with 55,000 unique issuers in the market, each has their own credit profile, their own collateral package, and their own repayment mechanism. The borrowers work with underwriters. They bring these deals to market in the amounts of anywhere from less than $1 million in a bond issue to a couple of $1 billion. The average size is on the smaller end of that because there are so many smaller issuers in the market. We become aware of these deals anywhere from a week to several weeks before they price in the market. And it's during that time that our research analysts take a lot of time to investigate the willingness and ability of those borrowers to pay. They investigate the security provisions, and we all come together as a team to make purchase decisions, examining the credit profile, the price, and examine if the price being offered is attractive versus all the other options in the market. And I'll add, while munis do have a historically low default rate, I still can't stress enough the importance of active management, the importance of a solid credit research team, not only to pick out the bonds at the time of purchase, but also to monitor those bonds over the life that we hold them or the life of the bonds themselves.
And that's why we have 4 investment professionals who cover exclusively municipal bonds. Which
Absolutely.
you got to cover all 55,000.
No small task. So what role then do municipal bonds or can municipal bonds play in an investment portfolio?
Yeah, there's a few roles that muni bonds can play in an investment portfolio. Obviously, the first, it's a highly rated asset class that offers a competitive tax-exempt income. The second thing is just diversification. The borrowers that exist within the municipal market are not the same borrowers that you're going to see in any other asset class. And all of the sources of repayment are unique as well. There's historically a low correlation between municipals and corporates in terms of spread action. So they don't necessarily move together in times of economic turmoil or disruption. And oftentimes the municipal bonds are seen as a safe haven in times of economic turmoil. There are a couple of non-financial reasons to consider as well. We kind of touched on it in the video. But you get to see your money at work in your community and across the United States, right? It's in the roads that we drive on, the schools that our kids go to, the airports that we travel through, and the museums and the parks that we visit. Our investments built these things. And then lastly, and I'll only mention this because it is tax day, but I have heard before that there is a little bit of a dopamine rush that you get from seeing a tax-exempt line item on your tax returns.
Absolutely.
Yeah, I agree. It's very nice to see that
Yes.
on the tax returns. I didn't pay tax on that income.
Yes.
All right, well, let's maybe take a little broader look at what's happening in some different asset classes outside of muni bonds. David, do you want to talk about domestic?
Sure. I mentioned earlier, we favor domestic stocks over international right now. The big U.S. technology companies are really unlike any other companies in the world. These are fantastic businesses with huge margins, enormous scale, loads of cash, and most are buying back stock. The biggest challenge with these companies is that everyone knew they were amazing companies and their prices had run up a lot, especially in 2024. The Magnificent Seven, as they're called, have declined this year more than the overall market. And so by a lot of traditional metrics, domestic large cap growth companies are pretty attractive right now, especially over a long-term horizon, which is, of course, what we have at Thrivent. Now, as I said earlier, I'm trying to be the optimistic one, and I think we'll see what the economy does, but I think our next move would actually be to add to stocks, to do it domestically, and probably in large caps. Not that I don't like small caps, but large caps are less economically sensitive, and I'd like to see a little more stability in the economy before we legged into small caps.
Okay. Steve, what about from a fixed income perspective?
Yeah, I think one of the key themes that we've talked about is just volatility. Interest rates have been extraordinarily volatile over the past week or two. You've seen huge swings. So what's driving that? I think part of it is just this uncertainty, and investors are demanding a higher risk premium to buy them for that. And also you've seen heavy selling by international investors of U.S. assets, including treasuries, which pushes up rates. Essentially, we have a large trade deficit, and those dollars go out, and then it generally come back into U.S. assets. But now they're selling U.S. assets to a certain extent because of the volatility in global trade. And then you can see that in the lower dollar is a sign of that, because when you sell U.S. assets, that can put pressure on the dollar. And then also, and you might have heard in the news that there are some very leveraged investors in particular. And when there's volatility, that means they borrow money. They have to unwind those positions. So they're selling treasuries very aggressively through this. Overall, I think, though, if you look at interest rates, slower growth is going to dominate. I expect short rates to go down, like a 2-year, partly because the Fed will cut. And I think longer rates are going to be a little bit stickier. If you look at corporate bonds, yields look very attractive right now. But given the volatility and growth concerns, I would focus on higher quality, like investment-grade corporate bonds.
Mm-hmm. Stephanie, anything you'd add in the muni bond space?
Well, I've spent most of the time I had talking about the investment-grade muni space, so I thought I'd just share a little bit about the high-yield space, which comprises about 10% of the overall muni market. High-yield bonds are very similar, but they're smaller or more startup in nature. So instead of buying a Big Ten university, you're going to buy a small, private, maybe rural university. Instead of investing in a big K-12 school district, you might look at a charter school that has 3 to 5 years of operating history. And instead of buying a big town with a large tax base, you're going to maybe look at investing in a small development that exists sort of right outside of that town, where you're funding the core infrastructure as the investor, but you're relying on the developer to build those houses, sell those houses, and collect taxes on those houses eventually to repay the bonds. High yield tends to carry longer repayment schedules as per the nature of the projects themselves, and so they can exhibit a greater price volatility than shorter dated bonds. Diversity of holdings and a solid credit research is fundamental for high yield investing. So if you're open to a little bit more risk in your municipal profile, in your portfolio of your municipals, it is a great opportunity to capture additional yield. Currently, the 65-35 index, which is a common index used by high yield funds, is yielding about 4.8%.
Wow.
Tax-free.
Tax-free,
Tax-free.
exactly.
Okay. Well, after this next question, we're going to go to live Q&A, so everyone start typing those. But before we do that, I want to hear from all three of you. We've talked about a lot of different things today. As you look out across the horizon, what are the opportunities or bright spots that you're really paying attention to? David, I'll go to you first.
Sure, and I know I'm playing to my audience, but I do really like municipal bonds. And I think, in my defense, this isn't the first time I brought them up. The last couple of quarters, and that's why I thought it'd be so great to have Stephanie here. Within stocks, and I've already talked a little bit about large cap tech stocks, but I would be looking looking at quality growth companies of all sizes because it can seem a little counterintuitive, but when the economy slows, growth stocks can outperform because investors are willing to pay more for growth when it's scarce. I say quality, which means strong balance sheets, companies that aren't overly leveraged. That's also important because we continue to expect volatility in the markets and the economy, and higher quality companies are just better positioned to withstand that volatility. So I like growth and quality as factors right now.
All right, Steve?
Yeah, I would look at the volatility as an opportunity to add to markets if they materially sell off. You can buy them at lower valuations, and we're still kind of fundamentally optimistic about the economy and about earnings from companies. And you can kind of look at it as basically there's a sale on high quality companies right now. And there's still, as mentioned, really good longer-term trends in the U.S. Productivity is very strong. There's this long investment cycle in artificial intelligence, and this investment cycle in manufacturing too, and deregulation.
Productivity is a good point. We've talked about it in the past. We didn't have a separate question on it, but productivity has really been strong lately. So yeah, that's a real driver long term of real wages and just people's economic outcomes.
Excellent. Stephanie, what would you add?
Well, David did a great job of highlighting munis, but I would just reiterate, I guess a few key aspects. One, right, the absolute attractive rate environment, well above a 4%, the tax-exempt nature of that return, diversification of the asset class. Again, the borrowers and repayment streams are not present in any other asset class. And then lastly, it's the feel-good investment, right? You feel good because you see in tax-exempt income, and you're feeling good because you're seeing your investments at work in your community.
All right. I love it. What a good note to end on there as we go pop the hood on these questions for live Q&A. We are very excited. We have great pre-submitted questions, and I already see some great real-time ones coming in too. First question, let's talk about, here we go. There is a question about money market funds from Kathleen. She's wanting to know, are money market funds a safe place to be right now?
Money market funds are generally a safe place to be. They maintain a stable net asset value of $1 per share. But it's important to remember, the only way you can make money on a money market fund is from the yield. You can never have any capital appreciation. If rates go down, you don't, unlike longer term bonds, you don't have any appreciation. There are record amounts of assets in money market funds across the United States. It's over $7 trillion now. It's a couple trillion up from where it was a couple years ago. We've seen significant increase in our own money market flows as well. And I want to make sure investors aren't missing out on an opportunity, because as the Fed starts cutting rates, and we think they will this year, the market thinks they will, the rate you're receiving on your money market fund will go down. It's almost immediately when the Fed cuts rates. And again, you have no potential for capital appreciation. Whereas if you diversify your holdings to longer terms, still high quality bonds, then you can benefit from lower interest rates by buying, say, high quality corporate bonds if it's in, say, a tax deferred account. But if it's in a taxable account, definitely you would be looking at municipal bonds. So I think there's probably too much money sitting in money market that probably could go into other high quality fixed income right now.
That's a potential positive for the market over time, as people pull their money out of money markets and into the equity markets.
And we talked about the lack of structural imbalances in the economy that might cause a recession or something. The cash sitting on the sidelines, and as well as the untapped home equity, the consumers are in pretty good shape.
Yeah. Absolutely. We have a question from George, and it kind of reminds me, we usually touch on more of the geopolitical tensions a little bit and conflict. George would like to know how war or tensions in the Middle East and in Israel would affect markets, and maybe taking it even a little broader, Steve.
Yeah, if you look at the Middle East, it has been volatile and continues to be volatile. The historical record is that it does not affect markets over time. Where it could is if you had damage to the oil infrastructure in particular. So if you had a broader war there, and that's exactly what happened during the Arab-Israeli war in the 70s, is it wasn't damage to the infrastructure, but there was an embargo to the U.S., and that had a big impact on the economy then. But generally, we've talked about this before, wars don't impact the economies over a long run. The geopolitical environment continues to be very challenging right now. You're seeing kind of this post-World War II order break down. We have our challenges with Europe right now. We've pivoted a little bit toward other areas. And I think one issue is that global trade kind of binds everybody together, and as that fractures, it could create conflict unless you have less to lose. And in particular, if you look at China, if they're less attached to the U.S., that makes, I think, in the long run, them more likely to do something with Taiwan.
Okay. Maybe a nice transition. We have a question from Tom. The outlook for energy prices in the near and long term.
Yeah, so a bright spot. Energy prices are down pretty meaningfully. And that's an aid to the Fed in keeping inflation under control. You know, I mentioned the most recent consumer price index print, which core inflation was up, I believe it was a tenth in the most recent CPI. But the headline inflation, which includes food and energy, and despite the increase in food, was actually down a tenth. And that was driven by a decline in energy prices. So we've had strong domestic production. That's the positive. The negative is energy is highly cyclical and economically sensitive. So with expectations of economic slowing, you would expect energy in general and oil in particular to decline. You know, we talked a little bit earlier about consumer inflation expectations. Yeah. Steve mentioned the University of Michigan survey where they've really popped. Historically, that survey basically tracks gas prices.
Almost one.
That's what people see. It's harder to, in your rent, in your house, it's harder. You see your gas prices every day when you fill up your car. So it's interesting that gas prices have declined meaningfully, but we've seen that increase in inflation expectations because people seem now to be more immediately focused on tariffs than they are on energy and gas prices.
And if you look at part of the overall trade policy for the United States by the administration, one thing they want to do to offset the price increases from tariffs is have low energy prices, in particular oil.
Okay. Stephanie, we have a question for you from Jesse. What is the probability that municipals might lose their federal income tax exemption with new tax policy changes?
Yes, so this is certainly not the first time that this issue has come up. I feel like every time there's a new administration and they're looking to raise revenues, they open up the notion of the value that tax exemption provides. But the truth is it provides a tremendous value. All states benefit from it. All communities can benefit from municipal tax exemption. So it historically has gotten a lot of bipartisan support. At the margin, there could be adjustments to the tax exemption, but we're pretty confident that the underlying structure of the municipal exemption will remain intact.
Yeah, but I think politically that would be very hard to do because every state, every big city, every city dependent on it.
Yeah.
75% of the infrastructure. That was such a great statistic. I did not know that statistic before we started preparing for this.
It is a great stat and unreal, actually. Very real. Very true, not unreal. Yeah, I got to be careful what I say. Okay, how about a question here, actually a pretty serious question about the devaluation of the U.S. dollar. This is from Adele. How would the strength of the dollar affect investments and cash on hand?
Yeah, it could have a large impact. We already talked a little bit about the dollar and why it's lower, partly because international investors are selling U.S. dollar assets. What's interesting is normally when rates are going higher, like the 10-year rate, which it has significantly, the dollar does very well.
People want to get that higher rate. Yeah.
Yeah, exactly. The impact of it, so a lower dollar can increase inflation because of imports. It raises the price of that. It can raise earnings because you're taking, you get more dollars out of earnings in euros and so forth.
We have a question from Mark. How critical is it to manage down our national debt levels for the success of markets?
I think it's very important over time, extremely important. We're at a level that's absolutely unsustainable. The biggest line item in the budget is interest, on our own debt. If you look at historically, it doesn't always matter until it does, and then it matters a lot. And that's what happened in Europe during the debt crisis. All of a sudden, Greece and Italy were basically unfundable. That's happening in the United Kingdom recently. The rates have gone up very high there, partly because they're concerned about overall debt. So it's something that we will have to figure out within the coming decade, I think.
How about at like the state and local tax levels and debt levels? What is that?
Yeah, I would not categorize states and locals within the United States as over-levered. the vast majority, as over-levered. States, by their constitutions, are required to have balanced budgets. Sometimes they fudge that a little bit, but overall, debt loads are very manageable. They're typically evenly paid over 30 years or less, and debt service obligations, as opposed to the federal government, typically are averaging about 5% of total budgets. So certainly quite affordable.
Yeah. We have a question from Dennis and Anne. They would like to know about buying gold. Is that a safe kind of bet right now for investing?
Yeah, lots of questions about gold recently. Gold recently hit all-time highs in the past week or two. The question I always respond to the question with is, what problem in your portfolio are you trying to solve with gold? Gold has historically been viewed as an inflation hedge, and it's historically functioned as an effective inflation hedge. If you're worried about the declining dollar, you might want gold as a store of value. But I think there are other more diversified ways to accomplish those same objectives. I think gold could be a part of that strategy, but commodities and materials generally can serve as inflation hedges: oil, energy, materials. And so I would probably look at a more diversified portfolio of materials and commodity stocks. Gold miners could be a part of that, or even a gold ETF. But I would probably have a more diversified portfolio too, if that's the primary concern you're trying to address. And gold is at all-time highs right now.
It is. And one of the reasons for that is you've seen some countries put part of their reserves into gold and diversify away from U.S. dollar.
Mm-hmm. Maybe somewhat related, Tabitha has a similar question on cryptocurrencies.
Yeah, a similar answer with crypto. And not all cryptocurrencies are the same, but maybe I'll focus more on Bitcoin, which has not performed as well recently. It's well off its all-time highs, and I think the market and consumers are trying to figure out what Bitcoin is and what its role is, and this would be similar for some other cryptocurrencies. It hasn't functioned as well as gold as an inflation hedge. In 2022, when inflation was running much higher than it is today, it did not perform well. Bitcoin declined pretty significantly, and so did most cryptocurrencies. I think so we're trying to figure out what the correlations are. Is it correlated more to like small, unprofitable technology stocks like it seemed in 2022? Is it more of a store of value and an inflation hedge? The role where I think it could have that would be an interesting one in a portfolio is Bitcoin in particular, and most cryptocurrencies are quite volatile. And so if you have a volatile asset that isn't as correlated to other things, that can be a valuable diversifier. You wouldn't necessarily want a big position, but a small volatile asset is just a slice of a portfolio could provide some diversification benefit.
Yeah. I think we probably have time for maybe one more question, and I'm going to make it a summary of a lot of questions that I'm seeing coming in, and I'll give it to you, David. There's a lot of people asking, in this type of market environment, how should they be investing? What should they be doing?
Yeah. At our last market update, I said, we were anticipating volatility, and the best way to prepare for volatility is to expect it and not be surprised by it. It was historically low last year. This is, it's historically high now, but we go through these periods. And the first thing you want to do is not panic and sell the thing that's gone down, because that will actually...
Which can be hard to do.
Which might be hard to do, because these things are emotional. But if you did that, that would push you farther away from your long-term target allocation. And so very good time to meet with your financial advisor, and maybe meet a little more regularly, or make a special call, because in periods of volatility, you just get pushed away more quickly from your target. I mean, the S&P 500 is only down about 10% this year, but it went down at a very rapid, historically rapid pace.
Extremely, and I think it's really important to have kind of a long-term strategy and stick with it. One of the things about volatility is it cuts both ways. The markets can go down, but they can move up very, very quickly. And if you're out of the market because you're worried, and you can lock in losses that way.
Yeah, that's a great point. So a good time to have a conversation with a financial advisor. All right. Well, we have a couple kind of final questions, including a fun one. I'm sure you're all waiting to know what's
Why
going to happen
why
with
are the
these
eggs there?
Yeah. Before we get to that, David, again, Thrivent is a large company. We have a lot of assets under management and advisement. How are we doing in this market environment?
Yeah, and I'm particularly pleased to be able to respond to that when there are periods of volatility. As of year end, Thrivent had $17.8 billion in adjusted surplus and $194 billion in assets under management and advisement. Those are both records. We're almost at the $200 billion level. That'll be a lot of fun. Our credit rating was recently affirmed by Standard & Poor's, the large credit rating agency, at AA+, which is the same rating as the U.S. government. So, with one of the strongest capital positions in our entire industry, I just want to assure our clients that Thrivent is well positioned not just to withstand, but to thrive amid all the volatility we're seeing in the markets and the economy. So we really appreciate the trust they place in us.
Absolutely, absolutely. Okay, let's get to the eggs. So here was the ask. Bring in an egg that represents where you think markets will end 2025. Red, of course, is not great. Yellow kind of in the middle, and green is with some growth. So David, I don't know, do you want to go first?
And it will be clear that no professionals were involved in coloring these eggs. So mine is yellow and green, and it's sort of a mixture. It's not all one or the other, because I think we're going to see continued volatility. I don't have any red on my egg. I don't think we're going to see a crash, but I think there are going to be periods of yellow, which I guess stands for caution, where we're going to see that volatility. But I am on record, and I do believe that the market will end 2025 higher than it is today. The other reason, my egg's doing a twofer here, for the green and the gold is because I am a very big Green Bay Packer fan. I'm from the state of Wisconsin, and a week from Thursday is the NFL draft in Green Bay, Wisconsin. I don't know where Green Bay is going to put 500,000 people, but it's going to be a wonderful thing for us.
Much larger than the population.
Much
area, right?
larger. So.
All right, well, I like that egg. Steve, I'm going to toss you yours here.
All right. So, in full disclosure, I outsource my egg
to my children.
Yes. So again, it's very similar to David's. We've been in the red markets. Red represents down generally in markets, but you see it gradually by the end of the year going to yellowish and then to green. So I think the longer term outlook is good, and you just got to ride out volatility.
All right. And I think this purple one's yours too.
Well,
right?
I had to counter the Packers with Vikings purple.
Okay.
But the only problem with Viking fans so far, all we've ever had is hope as far as winning the Super Bowl.
Yeah, it's true. All right, Stephanie, I'm hoping that red that I see is not your market egg.
So my market egg is green.
Okay.
And I wasn't talented enough to do the multicolored. I haven't dyed an egg in 20 years, so it was fun. But it's a light green. That's just I'm optimistic. I do feel like markets are going to move up, but not overly optimistic. The red is not a sign of the economy. I just couldn't let the Packers, the Vikings go. I'm not an NFL person because I'm from Nebraska and all we have is college sports. So I just brought an egg to introduce myself as a Nebraskan, alumni of the University of Nebraska, and to demonstrate my artistic ability.
I think you get the award.
Invisible,
Yeah, that's
the visible,
impressive.
yeah, or maybe my husband's
Big red,
artistic
right?
ability. Yeah,
The nickname,
exactly.
yeah.
Exactly.
All right. Well, we have gotten to the end of our time today. I remain so grateful to the three of you for the insights that you've provided to us in this important conversation in a particularly volatile time. As we turn to you at home, as you've heard in the last 58 minutes and likely felt over the last couple of months, we are in a period of market volatility. And during times like this, it can be easy to feel stressed and also to feel uncertain about how to best navigate your personal finances. This is exactly the time to have a conversation with a financial advisor. They can help you translate this broader environment to your financial strategy so you can stay on track, and they can help you navigate those emotions too. Thank you again for joining us for this market and economic update. We hope you have a meaningful Holy Week and a wonderful Easter celebration. We will plan to talk to you again at our next conversation in July.